Welcome to the debate. We are diving into what I believe is, frankly, the single most urgent, high-stakes dilemma facing retirees with substantial savings today. The question is stark. Is proactive, decisive asset protection, moving capital away from traditional holdings, necessary right now? I mean, really necessary to hedge against a potential systemic economic event, especially one stemming from commercial real estate? Or does taking that kind of aggressive action actually introduce unnecessary operational complexity, liquidity risks that are frankly just as destructive to a retirement portfolio?
That's a critical framing, definitely. But I have to argue, we need to, maybe slow the pace of panic just a bit. While these macro risks are undeniably severe, I think focusing on risk reduction and, importantly, simplicity is paramount for the high net worth retiree. I really assert that attempting these aggressive, complex maneuvers often leads to financial catastrophe much faster than a gradual market correction. Why? Because it exposes the investor to personal, operational, and yes, cognitive risks that are inherent in that complexity.
And I will assert that inaction is a ticking time bomb. I genuinely believe retirees are sleepwalking into disaster if they remain complacent. The current environment demands immediate preparation, diversification away from assets that are, let's be honest, mathematically guaranteed to be repriced downward. It's not optional anymore. It is mandatory defense.
Okay, let's start with your central thesis then, the market foundation shifting. You speak of mathematical guarantees. Can you spell out the fundamental threat as you see it? Lay it out for us?
The data is screaming at us. Just look at commercial real estate, CRE. We are facing an unprecedented $2.7 trillion in CRE debt, hitting a wall within the next, 2 years. Now, this wasn't originated at today's rates. This was cheap money, originated at 2 to 3%. Now, those same loans require refinancing at 7%, 8%, maybe even higher. This is not, I repeat, not a cyclical recession. This is a fundamental mathematical deleveraging of an entire asset class. It threatens to wipe clean the balance sheets of community banks and fundamentally reprice the value of the American city.
I acknowledge the scale, the staggering scale of that $2.7 trillion debt wave. It's a genuine macroeconomic threat, no question.
It's more than a threat. It's a near certainty in terms of impact. Consider a simple example, right? A $100 million commercial property. It's generating, say, $5 million in net operating income, NOI. Okay, at 3.5% interest, the debt service was manageable. But now, at 7%, the interest alone is $7 million. The property is underwater by $2 million annually before you even touch the principal repayment. We're seeing situations where that exact property can maybe only support roughly $48.4 million in debt. That means the property's valuation has to drop by over 50% just to make the math work on the debt. And look, major market veterans are seeing this. We know Warren Buffett is reacting, stockpiling massive amounts of liquid assets, T-bills mainly. This environment creates generational wealth opportunities, absolutely, but only for those ready with liquid capital. It demands immediate diversification away from these vulnerable, over-leveraged assets.
Okay. I see why you think that action is mandatory. But I come at it from a different angle. The solution you're advocating for, this proactive, aggressive action, it often pushes retirees into high management or, crucially, illiquid assets that carry just crushing operational risk. While the systemic picture looks dire, yes, many attempts to solve it introduce personal failures, human failures, that destroy wealth faster than the market itself.
I'm not convinced that diversification automatically means becoming some kind of active high-input manager, though.
Perhaps not always, but the urge to chase yield, especially in this environment, it leads high net worth retirees into incredibly complex, illiquid structures that are frankly utterly inappropriate for their age bracket. Think about sophisticated real estate funds or Delaware Statutory Trusts, DSTs. These are highly illiquid partnership arrangements. If your health changes, if you suddenly need capital for long-term care, or if you simply need to rebalance your portfolio for any reason, you are completely trapped. You cannot liquidate a DST position in 3 weeks, maybe not even 3 months. This lack of flexibility can be catastrophic. And furthermore, we have to address cognitive health decline. It's uncomfortable, but it's real. As people age, often their confidence in financial decision-making actually increases, even while their actual cognitive ability might be subtly decreasing.
So, if a retiree is locked into a complex, illiquid fund and then refuses to pay the necessary legal or accounting fees to properly manage the exit because, that costs money, they expose themselves to profound losses. This cognitive vulnerability, it just undercuts the perceived safety of any complex hard asset.
Right. I do acknowledge the dangers of illiquidity and the complexity in some of these specialized funds. Absolutely. But let's circle back to the systemic pressure point that I believe demands action. The CRE contagion. That $2.7 trillion debt wave, it sends massive economic ripples, doesn't it? Because local and regional banks hold nearly 70% of these loans, they are going to face a devastating wave of defaults and pressure. That leads inevitably to severely tightening lending standards across all sectors, including residential mortgages, even if the residential market isn't fundamentally broken in the same way.
While I agree the CRE decline will impact local economies and potentially lead to job losses, which could pressure residential property taxes, I think the residential market does have some real insulation this time around. This is fundamentally different from 2008. 70%, maybe more, of single-family homes are locked into mortgages under 4%, and the general market, it just has a much more solid foundation because of the stricter post-crisis lending standards. So I'd caution against panic selling residential real estate, which actually offers genuine stability right now with those fixed low payments.
Okay, fair point on the stability of the residential debt structure. I'll grant you that. But flexibility remains meaningless if you lack liquidity. And that brings us to the trap many sophisticated retirees fall right into: the 1031 exchange. Now, while it's powerful for tax deferral, sure, the 1031 process itself creates severe liquidity limitations. Those strict deadlines, 45 days to identify, 180 days to purchase, they force investors into rushed, often non-ideal purchases. It becomes a high-stakes game of financial hot potato, really, and it reduces flexibility precisely when market conditions demand agility.
You've hit on a critical financial flaw there. Illiquidity is absolute poison for older investors. Tying up capital makes it almost impossible to address unforeseen health issues or long-term care needs down the road. But you're also perhaps glossing over the second layer of this complexity trap, the eventual tax hit. Unwinding a portfolio built on years of 1031s means paying all that deferred capital gains plus the accumulated depreciation recapture, which crucially is taxed at ordinary income rates, not capital gains rates. Converting these assets back into liquid cash, it requires tremendous legal and tax consultation. That's complexity that is genuinely hazardous when cognitive decline risk is a real factor for older individuals.
I acknowledge the data on cognitive decline, certainly, but I think your interpretation of where the primary risk lies is maybe misplaced. The real challenge isn't just the difficulty of the tax code itself. It's finding a protective, non-operational mechanism, something that offers resilience and liquidity without the crushing operational complexity you rightly point out in unwinding a complex real estate portfolio. And this need for a simple protective hedge is exactly the gap I see constantly among the high net worth retirees we speak with. Retirees sitting on, say, $100,000, $250,000 or more in their retirement accounts. They get the why. They understand the why behind diversifying away from the traditional stock bond real estate cycle. They see central banks accumulating gold at 50-year highs. They see the instability, and they want a simple, institutional-grade, non-operational alternative. But the how is terrifyingly complex, especially when you're dealing with IRS rules for IRA and 401k rollovers. That is precisely why accessible, detailed education is paramount right now. We've actually compiled a comprehensive, free Gold IRA guide. It's specifically designed for Americans with at least $100,000 in retirement savings, whether that's in IRAs or 401ks, who need exactly that, non-operational hedge against systemic repricing and inflation. The guide, it details how the rollover process actually works, what the real costs are, what allocation strategies make sense, and specifically how to avoid the common complex mistakes we've been debating today.
It really provides a solid, maybe 15-minute foundation to help you take decisive action without incurring that dangerous management risk. Now, here's something important. For those qualified individuals who really need highly personalized education, maybe on their specific tax situation or portfolio structure, we have opened up a very limited number of free educational web conference spots just this week. There are only 7 total available. Now, these are strictly no-obligation sessions. They're designed purely to educate you on the mechanics and help determine if this specific strategy actually works for your situation. You can see if you qualify for this personalized educational opportunity by downloading the guide first. The link is in the description, or you can call our direct educational line, 877-607-9367, to discuss qualification and check availability.
Okay, I will concede that simple, non-operational diversification into genuinely resilient assets is a far superior strategy than, say, complex, active asset management for seniors. However, we must view any product or strategy designed for seniors through the same strict lens of operational risk, including the one you just mentioned.
And the value of the education is precisely that it simplifies the process while directly addressing the risk you're highlighting.
Well, let me use another complex financial product designed for seniors as a case study here. Home equity conversion mortgages, or HEMs, commonly known as reverse mortgages, they are intended to provide financial relief, right? Yet nearly 1 in 10 HEM loans actually defaults, and often it's due to the extremely simple operational failure of missing property tax or homeowners insurance payments. It's basic stuff. The data proves that complexity harms the vulnerable investor. The critical risk factors for HCM default, they're tied directly to things like high initial withdrawals and, frankly, low financial literacy. Now, new government safeguards requiring financial assessments, setting FICO score minimums like 580, demanding escrow accounts for riskier applicants, they do reduce the default rate by up to 44%.
I acknowledge the high failure rate inherent in complex debt instruments, especially when they're targeting cash-poor seniors. Yes.
Right. But the very fact that the federal government must enforce these stringent oversight requirements, requiring credit minimums, mandating escrows, it proves that the most vulnerable seniors often cannot handle complex financial obligations, even when the underlying asset, like their home equity, is perfectly solid. This just reinforces my core point. Complexity kills wealth for retirees.
Okay. I acknowledge the need for stringent oversight with HECMs, but I would challenge the relevance of that comparison directly. You are comparing a high-leverage debt instrument designed for seniors seeking liquidity, often out of necessity, against what is fundamentally a conservative, tax-advantaged capital preservation strategy often used by high-net-worth individuals looking to hedge. The default risk on a HECM is just not analogous to the management risk, or lack thereof, of rolling an IRA into a non-operational, non-leveraged asset like physical gold. If anything, the failure of HECMs confirms the need for proactive asset protection mechanisms, but the chosen vehicle must be non-operational, avoiding management risk entirely and providing liquidity and simplicity. The greatest risk I still maintain remains systemic exposure coupled with illiquidity.
And I maintain that the biggest immediate risk to a retiree with significant assets is the operational complexity and the liquidity limitations imposed by rushing into the wrong solution, a solution they don't fully understand, compounded by the unavoidable realities of aging. Caution remains prudent. The focus should be on simple, low-management, truly resilient assets.
And I maintain the risks in the macro environment, the near certainty of the CRE collapse's impact, the ripple effects on local banks, the fundamental repricing of debt across the board are simply too substantial to ignore. Retirees, especially those with substantial savings, must act now to move capital into highly protective, resilient, non-operational positions to avoid having their lifetime savings repriced downward by these systemic failures. The path forward requires education, yes, but also immediate, decisive preparation, starting with understanding the safest how.
Ultimately, I suppose, both preparation for external macro threats, which you emphasize, and careful caution regarding internal complexity and execution, which I emphasize, are crucial elements of retirement security in today's, volatile environment.
The listener must weigh that urgency against the very real hazard of poor execution.
Agreed. And we encourage listeners to explore the source material further, to really deepen their understanding of both the magnitude of this potential CRE crisis and the critical risks involved in age-related financial decision-making. Thank you for joining us on The Debate.